Good morning. I'd like to call this meeting to order. Thank you for joining us during our weekly hybrid MLS breakfast meeting. My name is Jeff Huang, and I am your February program chair. At this time, help me welcome our guest speaker, CPA Jeff Huang. I like to consider him my better half. So Jeff Huang is a seasoned CPA, over 20 years of experience in public accounting, including experience with Arthur Andersen, one of the big four accounting firms, and senior management experience as a CFO and controller, and a private accounting experience in one of the Fortune 500 firms. He specializes in small and medium-sized business management and tax planning, real estate taxation and planning, foreign national taxation, IRS audit representation, startup business, accounting, financial reporting, and management consulting. In addition to a CPA and MBA, Jeff is also a certified QuickBooks Pro Advisor, Microsoft Certified Professional, and Microsoft Certified Database Administrator. Let's give Jeff also likes to play tennis, read books, and volunteer for community service. Let's give him a warm welcome.
Thank you, Jeff. That's my great pleasure to be here. The one thing I would like to add on, I'm the member here since 2002. So this is my home. This is my home. So when I come here, I feel everybody just like family. We all welcome. So today, David's birthday, and also I see a lot of face here, especially my another brother, Jeff Huang. So I wish I had the same reputation as Jeff Huang. So today is all about you. Actually, also I get my license as a real estate broker, but I don't practice. I don't practice. And look up MLS. You don't see Jeff Huang have too much listing. Yeah, the reason I get license because that helped me to understand the real estate tax side. So that make me to help out our clients and also realtor as you on the tax side, how to maximize your tax benefit for realtor and how to minimize our tax. So we have the handout, that's for you today. We also have the handout. The handout will list out about 16 strategies. So when we have the real estate investment, we have capital gain, and sometimes we have the question from our clients and ask us how to minimize our tax. So on this handout, we have 16 strategies for you. So today we don't go over today, but if in interest, maybe we can go over on the next section. So today a lot of things for me to go over because 2024. So that new tax update. For example, if you buy your EV car, electric car, for example, you buy your EV car, electric car, if you go to the dealer, start January 1st, 2024, and you will get instant rebate, 7,500. So that means that when you get out the dealership, and they automatically reduce 7,500 for the EV credit if they qualify. So that's something new this year. So I need to go over today and to talk about the pros and cons. The other thing is 2004, a lot of new tax change, and I would like to share with you. And also the other thing is 2024, do you know anyone about the Transparent Act? If you own LLC, you are the 25% shareholder of the corporation, including S Corp, C Corp, sometimes the trust. We had to report the ownership start 2024 January 1st. So that's new thing, and a lot of things. And also, I know that a lot of you asked me, we had the client from the foreign country, and if they have some real estate investment here, what is taxation? And also, I know that I get some question about the incorporation, sole proprietorship, S Corp, C Corp, LLC, pros and cons. But I know that today I only have 30 minutes, so I cannot go over all them together. Let's concentrate the new things first, and also have some case study. So start the case study here. I just give you some case study first before we start. So Sarah and Sam both are realtors, and they just purchased the car, electric car, and received the rebate, the instant rebate 7,500 in 2024. So let's take a look at some of the key things. They both vary, and they have the commission about 390,000, and also have another stock and dividend income about 15,000. So one thing I would like to draw attention, the total, the AGI annual income is 405,000. So I'm stuck right here. So they receive the instant rebate 7,500 right now when they buy the car. Are they qualified with the income here? No, okay, a lot of things. Oh, good. What's the reason they don't qualify? Too much. Okay, that's good. So I'm going to share with you the number here. If you marry and you find married jointly in 2024, the AGI had to be lower than 300,000. So let's work together after today. Let's work together how to reduce the income from 405,000 to less than 300,000. The other case, I mean, I would like to share for you. We use the two technique. Use the cost segregation and retirement strategy to reduce the taxable income. So in this case, Michael is a realtor, also the real estate investor. So he's 50 years old, and he had the real estate income about 250,000 before we do anything. So the tax is about 82,253. And let's take a look what action item we take and reduce his tax to $1,000. So let's keep those in mind, and we go to all the foundation, all the basic for 2024 tax update first before I answer those cases. So let's take a look. First thing, let's take a look what's the change for 2024. What's the key change? First thing, we take a look sorry about that. I get the other way. Sorry about that. Okay. Let's take a look at the tax bracket. Let's take a bracket. One thing I would like to draw attention here. Our tax bracket is 7 tier. It's 7 tier. So from 10%, 12%, 22%, 24, 32, 35, and 37%. And also I have the income. So for example, we are single. I'm single. If he has taxable income about 300,000. So the question for everybody, what is his marginal tax bracket on 2024? I hear 35%. That's correct. So if take a look at the table here, if single over 300,000, that's over 243,000. That's on the marginal tax bracket is 35%. So let me explain to you the marginal tax bracket, what that means to you. So that means that additional $100 you're making, you have to pay $35 on the federal tax. Yeah, that's congratulations. So we had a nice problem here. So the other things as a real estate realtor, so we helping our clients. So the other things I would like to draw attention is the long-term capital gain in 2024. There's some update on the 2024 here. So that's the table for the long-term capital gain. Long-term capital gain means that we hold the property more than 1 year. So that's long-term. So one thing I would like to draw attention, if we take a look at the tax bracket here, do you notice that 0%, 15%, and 20%? So that means that our client, if they have the long-term capital gain, they there's some possibility they don't need to pay tax if they fall on this bracket, single between 0 to 47,000, $25, and if they marry and is fall in 94,050, less than that. So they don't need to pay the capital gain tax for the year. And the same token, I would like to draw attention on the high tax bracket on 20%. So if they're making a lot of money and also they sell the real estate, and for single, if they over $518,901, and they are instead of 15%, they are going to be on 20% on the capital gain. So that's something like this table I would like to draw attention. There's something we can like a little bit tax planning to move around, make sure that we don't pay too much tax on the capital gain. So if you're interested how we move around the taxable income, I do have on handout on those 16 strategies here. One thing we're using is 1031 exchange, deferred income. The other thing is use the installment sale. So that way we realize the capital gain at the time they receive the money. Yeah, so today I won't go over detail on this stuff. So I do want to give you the key change for 2024 first. Yeah, I know that I have some problem with the screen here. So the other thing is on the retirement. So, and also that one thing I would like to draw attention. The question for you, for everybody, would you rather you put the money into your retirement saving account or give to Uncle Sam? And how many people would like to give your tax to Uncle Sam? Nobody. So that's the things I would like to draw attention. As a realtor, we have hard-earned money. So I would rather we put into your retirement saving account. So we have different kind of retirement saving account. We have IRA, we have the like 401k, we have the 401k catch up, and also we have the SEP IRA. So if you self-employed, we have SEP IRA. So for SEP IRA, the contribution limit, the limit is at 69,000 for 2024. So that means that in other ways, if we're making 100,000, if we qualify, we put the money on the retirement side, and the taxable income reduced. So, I mean, I have an example for you. I would like to introduce another concept because, I mean, we have the 401k. That's from the employee portion. We have the solo 401k. We have solo 401k matching. And the solo 401k is 2024 is 69,000. So what if we're making more income for this year and we would like to contribute more on the retirement side? So is anyone here about, it's called pension, defined benefit plans. Defined benefit plans, so that's the number for my, for 2024, you can be contribute up to 275,000 on the pension called defined benefit plan. Again, for the defined benefit plan, is come from the licensed actuary. So they do the calculation based on your age, based on your salary, and if you maintain your lifestyle when you retire, how much you can contribute. So I just give you some examples. I have clients, they're making around like 200,000, and then at the age 50, and I do see that they can contribute more than 100,000 on the pension. And some of the clients, they can contribute like 200,000 or max 275. So the other things I would like to draw attention is on the transition IRA. There's the income on the limitation here. So that based on whether you have the like 401k, 403b retirement from your employer. So I have the different numbers here. So one thing I would like to draw attention. So if you don't have any retirement plan with your company and you're single or married jointly, and you can contribute like the traditional IRA. But if you have the 401k or retirement in place, they are subject to the income limit. The income limit for single is 77,000. You just like phase out. So if you owe us 87,000, you are not able to deduct the traditional IRA. Yeah, but that's work around. It's called backdoor IRA. Backdoor IRA. Here's the Roth contribution. The Roth contribution. The Roth contribution. The income limit is a little bit higher than the traditional contribution. So if you don't qualify, if you don't qualify for the traditional IRA, you might be able to qualify for the Roth IRA. And if you cannot qualify both, maybe you look up backdoor IRA. And the other things I would like to draw attention, there's some change for the gift and all for the estate exemptions. So for 2024, so annual exemption is 18,000 per person per year. And for the estate exemption is 13.6 million. And for 2025, estimate 14 million, 14.1 million. So they might be sunset for the estate exemption. So maybe we need to plan ahead. So what if they don't continue renew the estate exemption on that? The other things I would like to draw attention is California income state tax. Do you know that California was the maximum for the income tax for California in 2023? Yeah, 13.30. And do you know that start from this year, how much is going to be in California on the income state tax? Yeah, so that's new change. That's new change. If you in California, we pay for the weather. We pay for the real estate. We pay for the appreciation for real estate. So that's what our profession are. So helping people making more money in California. At the same time, you will pay for that income tax. So here's the table for the state, for the income tax. So I have a different color. So if you see that green color, there's no income tax for the state. That including our neighbor, Nevada, Texas, like Florida. And if you take a look, like if the color become a little bit brighter or red, that means that we are in the highest incomes tax state. So let's take a look, California, what color we are. Yeah, so that is on the higher income tax state. We are in a higher income tax state here. We can talk, but I know that I talked to a lot of people. I mean, people like the weather here and also like the real estate here. So that's the California. Okay, I know that I'm a little bit tired, so I'm going to go faster. So the things for, as I mentioned, that if any of you going to buy the electric car in 2024, so that's a few things I would like to draw attention. So right now, if you go to buy the EV and the car dealership give you the model to qualify, and you get the instant rebate, 7,500. You get the money up front. But the things in 2024, so I'm going to hold on the question later. So I mean, I will answer the question. Yeah, so let me go through because I have 50 pages on the PowerPoint. I need to finish in 30 minutes. Unless you want to say, tell Jeff, I would like to stay here and listen to you for 2 hours. Yeah, so I hold on the question. So let's hold on the question. I get back to the question here. So the other things I would like to draw attention. If you get the instant rebate in 2024, that's the income cap. That's income limit. So that means that if you're single, if your AGI more than 150,000, you phase out. I will tell you the next slide. What if you don't qualify? What happened? So, and also the other catch for you, when we do the checking to the credit for next year, when you do the tax filing, we base on 2 years income, AGI. So based on 2023 and 2024. So if you're 2023, for example, you're single and your AGI less 150, you're safe. If you are more than 150,000 and you buy the EV car and get the instant rebate, 7,500, and we need to walk around, we need to have the tax planning. And we can check out my case study later on that. And the other things, what makes things different is 7,500 before is against your tax. So for example, if you owe $3,000 on the tax side and you get 7,500 credit, so we use 3,000 to offset your tax. The remaining 4,500, you won't get any refund. But this year, you will get the 7,000 on the instant rebate already when you buy the car. So that means that you already get the money. Okay, so, and also the other things I would like to draw attention here, for the car, there are more strict, more requirement on the EV car to be qualified. So the first one is like the car is come from North America. So had to come from North American. And also there are some suggest like the MSRP, the manufacturer suggest retail price, like for the normal car, 55,000 or less. And for the SUV, 80,000 or less. Yeah. And also they're looking into the battery, where the battery come from. So for example, Tesla Model 3, if they have battery come from China, they might not be qualified for the EV credit. But Tesla Model 3, I checked the website, and if you get the performer, they might be able to qualify. But again, the dealership, when you go to the car dealership, they know more than us. So they will tell you whether they qualify. And if they qualify, they give you the instant rebate, 7,500. And also, I would like to draw attention, the model keep change over time due to strict requirement. And the other things if you had a leasing auction, you might be qualified for the like the EV credit. But I would like to draw attention is the leaser, not the leasee. Okay, so the next slide I would like to share with you, what if not qualified? What happened? So keep those in mind. We get the instant rebate, 7,500. So that reduces your price. So when we file tax return and the dealership will report to IRS with your social security number. So yeah, so when you file tax, we check your AGI for 2 years. And if you don't qualify, you have to pay back 7,500. Yeah, no worry, no worry. Today is the February 1st. So the end of year, December 31st. So we have about 11 months to go. That means that the tax planning is very important. Keep those in mind. Tax preparation is everything after facts. We cannot change. But tax planning, we can plan ahead our income. We can reduce our AGI. So I can show you the sample later on that. Okay, so let's take a look like with those new change, how to maximize our tax benefit for realtors. I have 3 parts on here. So we talk about the common deductible expenses. And I would like to emphasize because lately I do a lot IS audit representation. And when it comes down to audit and what IS looking for, they're looking for the record keeping, they're looking for documents. And also I would like to draw attention is we need to avoid any common pitfalls. So especially when the computer system, when the AI. So nowadays when we do the audit and the auditor, they don't need to come to your office, our office to the audit. They check everything online. So use the computer checking on here. So the AI automatic fact, those draw attention. So, and I will share with you on those common pitfalls. We need to pay attention on that. Let's take a look at the common expense here. Home office, we can deduct home office. So we use our home as office. So when come down to audit, as don't require you have your room for the home office. You have to have a dedicated area for the home office. For example, the corner of my living room, I use that corner as my home office. So in that, what's the dedicated area? That means that I cannot have any personal stuff in the area. So I cannot have my dog's picture and my tennis racket over there. So it had to be dedicated area on that. And the other things we common area, so we have the mileage and we have travel. So mileage, we can use the actual and also use the mileage. So one thing I would like to draw attention for travel when it comes down to mileage, because as a realtor, we drive a lot. So we had a lot huge on the odometer reading here. So I would like to draw attention when it comes to audit. They require for 2 repair receipt. 2. So do you know why they need 2 repair receipt? Is the odometer reading for the time. So give an example. Today you go oil change, and today February 1st, and the odometer reading maybe 10,000. And around December 1st, you do another oil change, and then the odometer reading is about like 20,000. So they already know that like what's the range on the mileage over there. So if you tell us I drive 40,000 miles, it might not be possible. Yeah, and also the odometer reading, why they need that, the receipt, because when you do the mileage log, keep those in mind. We had 10,000 in the February 1st. The mileage log in the around February 1st, what's the starting mileage log? Should be 10,000. So if you put 40,000 on the mileage log starting point, and the mileage log is not correct. So keep those in mind. Keep 2 repair receipt for me. So that way, when you come down to audit, and you are better prepared. So we need to keep just happy on that. Beginning of the year, keep 1, maybe around middle of the year or end of the year, keep 1. So that way, when you come down to audit, so you're well prepared on that. And also like professional fee and dues and continuing education and the office supply. So telephone, internet, the insurance premiums. So if you buy E&O insurance, and also the business liabilities here, and also the crime meals. And the other thing is that if you subscribe any software, and we can deduct on those portions. And I mean, the other thing I would like to draw attention here as the self-employed or you have your own company, so you can always put the money on the retirement, on the contribution. So one retirement, so you don't want to put too much, and you can consider SEP-IRA or solo 401k. And also you can see that business card and postage shipping, that's all the common deductible expense for the realtors. Okay, how to avoid the common pitfalls. Before I mention this one, I would like to share with you when come down audit, what the eyes will look into. First one, they ask for the bank statement. The bank statement. Do you know how they read the bank statement? All the deposit, they consider income. And all the expense and take it out. And they will take out unless, I mean, they will ask you the question, and if they give the receipt, they put that in. That's the general on the other side. So the question for us, so if I put the number in and no audit, it's good. But come down the audit, all the expense, we had the documentation, we had the support, all the expense here. So that's the things for the common, avoid the common like pitfalls. Avoid overestimate deductions. And also, I would like to maintain accurate records. So nowadays we have cell phone, we have QuickBooks Online, and when we receive, do me a favor, take a picture. So that way, when come to audit, we ask for receipt, you always back up. Yeah, and also we need to understand the deduction limit. And also the things I would like to share with you is separate personal and business expense. And I mean, if as a self-employed or we have a small business owner, I always told my client, dedicate one bank account for your realtor or business related income and expense. Because when come down to audit, and you don't want to ask question a lot of income. So sometimes maybe your parent give you some gift. So they have 10,000, 5,000 coming in, and they will ask, when come down the audit, they will ask you, hey, provide me this document. That's the gift from your parents. So that's the best practice. Have one checking account for your business and also one credit card at least. And also, there are a lot of new change over the year. So maybe we stay informed on the new tax law. So I need to get lost on the checking. Do I have enough time? Okay. So maybe I will go very quick on those stuff here. And for the 2024 tax planning for realtor. So I think the first things we need to keep track on the records. Yeah, I know I have a bit problem on those stuff here. So, and also make sure that we keep the quarterly estimate tax payment. So I'm go very quick here. So the transparent ad here, start January 1st, 2024. If your LLC, C Corp, S Corp, so it impact about 32 million of business owner here. So if you own the business over 25%, it's required you to report the owner, beneficial owner. That's the difference on the timing side. And also that's the penalty. If you don't comply, that's $500 per day up to 10,000 or 2 years in presence. So I know that I'm a little bit out of time. I know the page here. And also maybe let me share with you my case study here. So what's the solution for the case study? I have a little problem to move slide. Yeah, can you move to the case study here? So that way I go through very quick. Yeah, go to slides. Yeah, so I don't have time to go over together. So, but next time, if I have time, and maybe we can come back next time. So let's take a look at the case study here. So Sarah and Sam, both realtor, I keep this in mind. They buy the EV car. They get the instant rebate, 7,500. So the income is 405,000. Is about 105,000 more than the required AGI. I mean, let me show you. We use two techniques to reduce the income for that. So the first technique. Can you go to the next page? Sorry. So we need to maximize our business deduction. That's one strategy. The other one, we will consider retirement contributions. So, I mean, for the 401k, we can contribute 69,000 on the 401k side. So if we do a better job, we document everything and we maximize our business deduction, we can deduct around like 45,000. So that will come down to next page. So that come down to the AGI, 291,000. So, we less than 300,000. So we qualify for the 7,500. So the reason I want to bring this up, because the new tax law changed. So we get the instant rebate. And right now it's February 1st. You're knowing the rule, and then we can plan ahead. So next year, you won't get surprised if you don't qualify. You have to pay back the money. So in this case study, we go back to see Michael is a realtor, also real estate investor. So his the taxable liability is 82,253. And after the tax planning, the new tax strategy reduced $1,000. So let's take a look what technique we're using. So we're using three techniques here. One technique is called cost segregation. Cost segregation means that if the regular, we have the property for residential 27.5 years depreciation, and the commercial 39. So if you want to expedite the depreciation, so we have to have the licensed engineer to give you the cost segregation. So that means that we can depreciate 5 years, 7 years instead of 27.5 years or 39 years. So in that case, we can expedite the depreciation 100,000. The other things I would like to draw attention, we are the real estate professional. So that means that there's special tax benefit for us. So for the loss from the real estate side, I mean, people will subject 25,000 loss on the past loss. And also their income too high, they cannot deduct all them. So if we are the real estate professional and 50% of our income come from real estate, including management, including real estate acquisition, and we can, and also we're licensed and we work more than 400 hours a year. So that way the loss, you come from the real estate side, you can all deduct. So not subject 25,000, not subject the income limit. And the other things in the case technique we're using the pension. It's called defined benefit plan. So we deduct about 150,000. Again, for the cost segregation and the defined benefit plan, your CPA cannot help you because we are not licensed to tell you the numbers. We had to go to the licensed people. They run the number and they endorse the number for us. So I know that my time is out. A lot of things I would like to share with you. So maybe next time, if you're interested, we can share more on the content over here. So again, thank you so much for your attention, and hopefully best wish for your happy new year and very prosperous new year. Thank you.
Let's go actually into one or 2 minutes of quick Q&A. So if we have 1 or 2 questions, we can at least answer. So is there any questions? If you can, please come up to the mic over here and ask your question. That'll help our folks, our Zoomers here in as well.
Are you aware of any IRS changes regarding real estate agents no longer being classified as independent contractors and becoming employees in 2024?
Yes, there's some change on the real estate like agent here. So that's, I mean, because the employee, that means that we had to pay the payroll tax upfront. So like when the employee, we had to pay the Social Security, just like you're working for the company, every paycheck. So you have paid the Social Security and Medicare. So right now, if you're a real estate like independent contractor, when you get the commission and you get all of them without any like Social Security tax withholding and Medicare tax withholding. Yeah. And also the recently I get the audit representation for the EDD side. So, and EDD side and also the most on the employee level. So if someone report to EDD and then they have 25 questionnaire to look up to. So whether you as the employer control the habit for the independent contractor. So one case, I have the audit is for the independent tutor. So right now they have the state program. So my client get the sponsor, the funding from the government side. So they hire the independent tutor and schedule the tutoring with the kids at home. So they go out to teach them. So the question for the EDD is, are they the independent contractor or employee? So they go to 25 questions. At the end of the day, because they get the state funding and because they need to follow the state requirement, and the tutor had to follow those stuff. So that's, they cannot pass this step. They had to be classified as an employee. So that means that the people, the company had to pay back all the self-employment tax for the people who's misclassified on that. So, I mean, I know that that's a new change on the way here. So 2024, the new tax change update. Yeah, thank you for sharing.
Okay, so we're out of time now. I do want to give Jeff a small token of our appreciation because we want him, and it's actually the perfect gift for today.
Thank you so much. That's good. Thank you so much.
Stay dry, stay safe.